Howdy, Team 42. It's your skipper here, Darius to present another episode of our Pro to Pro Live. Unfortunately, our friend Tracy Schuchart had a last minute cancellation. She had some things that she had to attend to. So we apologize for that. But as always, we want to make sure we leave you guys with a great show. So what we're going to do today is sort of open this up for an extended Q&A session. We had a lot of questions in our community chat over the past kind of week and a half. In terms of the volatility that we've seen in asset markets. And so I think this will be a great time for our clients to kind of to have a live Q&A session with myself. But before we do that, let me just run through a few things that I think will be helpful in terms of setting the stage for the discussion. So, just kind of clicking through let me start with our macro risk management process. So, we do things very differently from the perspective of managing risk here at 42 Macro. And we're very proud of that because we don't we don't want to be like the crowd. The crowd sucks at investing, for lack of a better word. So in terms of how we think about investing, we help investors identify and position for the market regime. That's the hallmark of our process. The number one tool we use to identify and help clients position for the market regime is our global macro risk matrix, which we'll touch on in a second. Step two in that process is we help investors prepare for regime change using quantitative signals vis-a-vis our macro weather model. We'll give a quick update in terms of where we are in macro weather model terms. And then lastly, we help clients prepare for regime change using qualitative signals, using our fundamental research process, which tries to piece together the puzzle from a growth, inflation, and policy perspective. And when you combine these two elements together, what the macro weather model is signaling from a rolling 3-month forward projection perspective, and also what our qualitative research process is signaling on a 3 to 12-month forward projection perspective. When you combine those two things, we can have a general sense on how the market regime is likely to evolve over time, in so much that we have an idea of how sustainable the current regime might be. And if it's unlikely to be sustained for a long period of time, what is it likely to transition into on a go-forward basis? So we're right now, in terms of our research process, we are in reflation. We remain in reflation, been in reflation for most of the past couple of months. We transitioned to reflation from Goldilocks, which we were in from November through, let's call it, early March of this year. And our quantitative and qualitative research processes, i.e. our macro weather model and our fundamental research process, are telling us to prepare for a rising probability of a phase transition to a risk-off inflation market regime. And so that carries with in terms of the transitioning from reflation to inflation, when just going down the factor long short preferences here, reflation, you generally want to be long risk assets, whereas you generally want to be long defensive assets. In inflation, you want to be long high beta in reflation versus long low beta in inflation. You want to be long cyclicals in reflation versus long defensives in inflation. You want to be long growth in reflation versus being long value in inflation. You want to be long small and mid caps versus value, small and mid caps in reflation versus large caps in inflation. You want to be long international in reflation versus long the U.S. in inflation. You want to be long emerging markets in reflation versus long developed markets in inflation. And so those are all the different changes and pivots you'll have to make in your portfolio as a investor in terms of staying on the right side of market risk, if we were to, in fact, transition to a risk-off inflation market regime, which, again, we have not done yet. But in terms of our signaling process, both on the quantitative and qualitative side, we're suggesting both of those processes are seeing a rising probability of a transition. In terms of fixed income, so spread products typically outperform in reflation market regime, whereas treasuries, particularly short treasuries, short duration treasuries, typically outperform in an inflation market regime. Fixed income broadly tends to suck in an inflation and reflation market regime. But again, you can crowd yourself into things like T-bills and kind of be relatively scathed from the negative absolute return environment there. High yield tends to outperform in both environments because duration risk is the real issue. It's not credit risk. That's really driving that negative performance in the fixed income space. And then in the commodities markets, commodities tend to have positive absolute returns and reflation across the board, with industrial commodities leading the way versus commodities no longer have positive absolute returns across the board. Only ag commodities, energy commodities tend to do well in an risk-off inflation market regime, whereas industrial commodities tend to suck wind. And then lastly, with respect to currencies, foreign currencies typically outperform the U.S. dollar and gold in a reflation market regime. Gold typically outperforms the U.S. dollar, Whereas if you're transitioning to a risk-off inflation market regime, you're talking about gold outperforming all currencies, the dollar outperforming foreign currencies, and foreign currencies having negative absolute returns. And so this is something that the currency market, obviously, if you look at the trailing performance of the dollar and of gold over the past several months, this is something that the currency market is starting to get wind of. And not all asset markets have to respond to changes in the economy or changes with respect to growth, inflation, and policy at the same time. There are different, various points in the cycle. Certain markets can lead and certain markets can lag, and those lead and lag relationships are not static and not stable over time, which is why you have to have a robust observational process like we do here at 42 Macro to identify those things in real time. So let's talk about the robust observational process that we use to identify and help clients position for the market regime. That's our global macro risk matrix. This is something that we refresh for our clients 6 days a week here at 42 Macro. And in terms of how this model works, we're scoring every major market in the world, all 42 of the most major markets in the world in terms of where institutional investors transact and set price from the perspective of our volatility adjusted momentum signal. Our volatility adjusted momentum signal is as described, as the name suggests. It is a momentum model that scores price with respect to volatility to determine the momentum and the sustainability of momentum for an asset market. And so, for example, using the S&P 500 on the left side of this chart here, the S&P 500's volatility adjusted momentum signal is currently bullish, and it has been bullish since kind of early November of last year. And what bullish means is that it has positive price momentum, but the volatility characteristics of the asset class are confirming that positive price momentum. If an asset has negative price momentum, that means, or as a bearish VAMS indication condition, that just means the volatility characteristics are confirming negative price momentum. Where the model really works and helps identify inflection points in markets is when you have a price or volatility disconfirming price, i.e. you have a neutral signal because volatility is not confirming either an uptrend or downtrend in price. So that's how our volatility adjusted momentum signal works. And we're doing that again across 42 of the most important markets in the world from the perspective of identifying market risk through the lens of the equity market here, volatility products, commodities, currencies, and then fixed income rates and spreads. And we're scoring each of those markets through the lens of their volatility adjusted momentum signal daily in order to identify which regime the market is essentially backing at any given time. So, for example, the S&P 500 here, ES1 here in the first column, the bullish VAMS condition of the S&P 500 is currently giving a point to both Goldilocks and reflation, which are the risk-on regimes in our nomenclature. And historically, the S&P 500 has had positive absolute returns. It's had a bullish VAMS condition, generally speaking, in Goldilocks and reflation. So S&P 500 being bullish doesn't know if it's Goldilocks or reflation. It just knows that it's probably one of those two. And so we're doing that same process all across the table to determine, which of the regimes has the highest share and sum of confirming markets. And currently, reflation is that dominant regime, and which is why really since going back to mid-March, we've said asset markets have largely been in reflation after having priced in Goldilocks really since mid-November. And so it's our, now that we've seen the probability of inflation rise substantially in this regime, in this quantitative risk management process, we now have to ask ourselves, what's the probability of actually experiencing a row phase transition from reflation to inflation? Because again, as we mentioned, transitioning from reflation to inflation is a significant change from the perspective of the types of bets you should be making in your portfolio in order to stay on the right side of market risk. And as an aside, you don't have to stay on the right side of market risk, particularly if you're a retail investor. If you're a retail investor and your risk management process is based on your predictions of the future, you can be long or short an asset that is going down in price if you're long or up in price if you're short for an extended period of time, because there's no risk manager to stop you out of the position and no boss to fire you and tell you to take a hike. But our institutional clients obviously have to stay on the right side of market risk in order to remain gainfully employed in terms of generating alpha in financial markets. And this is why our process is oriented around supporting their investment processes. And so getting back into this risk management process, to our global macro risk matrix. So, we are in a reflation market regime. When you're in a reflation market regime, you do as reflation market regimes tell you to do from the perspective of the key portfolio construction considerations that we outlined in that previous slide. But when you start to think about practically preparing for a phase transition in the market regime, you have to identify the kinds of exposures that are going to change from a factor leadership perspective when you go from reflation to inflation. And this is something that we've been preparing our clients for for a couple of weeks now, for several weeks now, in terms of identifying, okay, what are the proper trade recommendations in inflation, and how will those proper trade recommendations change if we switch regimes into inflation. And so obviously our clients have that table in their inbox. And so keeping it moving here to the second leg of the process, which is our macro weather model. We use this in our fundamental research to determine how long the current market regime is likely to persist, what the next market regime is likely to be, and when regime change is likely to occur. And so we do this by categorizing the principal components of macro into regimes themselves, and then we are relating that regime signal back into each of those asset markets on an independent basis to project excess return dispersion for each of those asset markets. And so as we see now, the stock market, the bond market, the commodities market, and Bitcoin vis-a-vis our macro weather model, based on the current constellations of the real economy and financial economy cycles in the table, based on those cycles, the current, each of the outlooks for each of the stock market, bond market, commodities, and Bitcoin are bearish. And so what that simply means in simplistic terms is that investors should expect below median returns in these asset classes over the next 3 months relative to the baseline of returns. And for the US dollar, it's quite the opposite. And so let's go down the list and see what's driving, what's contributing to each of those composite signals there in the middle of the page. So when we start with growth is currently trending higher. It's expected to inflect and trend lower over the next 12 months by 130 basis points. Inflation is currently trending higher. It's expected to inflect and trend lower over the next 12 months by 110 basis points. The unemployment rate is trending higher. It's expected to trend higher by another 20 basis points over the next 12 months. The implied sales growth rate is trending higher. The implied earnings growth rate is trending higher. The sovereign fiscal balance to nominal GDP ratio is trending higher. The US dollar real effective exchange rate is trending lower. It's transitioning to the financial economy cycles here on the right. When we look at liquidity from a US and global liquidity perspective, we use our 42 macro net liquidity model to track US liquidity. That is everybody's net liquidity model now. Our model has become the dominant model across global Wall Street when you check Twitter. So that's the Fed balance sheet minus the TGA minus the RRP balances. The global liquidity proxy should be the dominant model yet. It's not yet, but it will be in our opinion because it's a more powerful and more stable tool. That's the aggregated sum of global central bank balance sheets plus global broad money supply plus global FX reserves minus gold for all the major economies in the world. And both of those are now trending lower. Domestic credit growth is trending lower, as is global credit growth. The benchmark policy rate here is trending sideways, but the 2-year nominal yield spread relative to that benchmark policy rate is trending higher. It's pricing in rate cuts, but it's pricing in a lot less rate cuts than it used to be, as indicated by that positive uptrend. When we look at fear and greed through the lens of aggregated positionings in the dollar or in the currency market, in the bond market, and we started with the dollar, aggregated positioning in the dollar, when you look at all the major currencies plus gold versus the dollar, is aggregated positioning in the dollar is now in an extreme bullish condition. Aggregated positioning in the treasuries market is in a neutral position. Aggregated positioning in the commodities market is in an extreme bearish position when you aggregate positioning across the 19 components of the CRB index, and then aggregated positioning in the equities market is neutral when you aggregate all the equity instruments that the CFTC keeps track of. And so one final thing I'll mention is that each of these component signals contributes independently to each asset class in terms of projecting an excess return relative to its baseline. And so, as I mentioned at the outset of this discussion, the current constellation of signals, when you look at the stock market, bond market, commodities, and Bitcoin in particular, suggest the probability of remaining in a risk-on condition and market regime turns over the next 3 months is actually low. And so we have to start doing fundamental research to identify, okay, what's likely to call, is a row phase transition, i.e. going from risk on to risk off, or vice versa? Obviously, we'd be going from risk on to risk off in this condition, in this instance. What could potentially be driving that? And what's going to if we do see a high probability of a row phase transition, what's going to drive it? When is it going to drive it? And what catalyst should we be looking out for in terms of monitoring that for fundamental conviction and confidence in building a thesis? And so, we're not going to go through all 146 slides of this presentation here. That's obviously reserved for our paying clients here. But I'll just give you one quick highlight here, because it is a question that I just have to answer in our community chat feature and our client dashboard, which is I guess the San Francisco Fed just published another paper that said excess reserves for the consumer, or excess savings for the consumer, are actually still are depleted. And my response to that was, so the client was asking, hey, do you have any thoughts on this? And my reply was the same thought that I had a year ago or 2 years ago when they said it was depleted, which is, I don't care what these people are saying because their analysis is wrong. we view our analysis as more correct in terms of identifying the spending power that we continue to see in the consumer spending, which is continues to grow above trend in the most recent data. So in our opinion, we've been hearing about this excess savings being depleted for months now. No, not for months, for multiple years now, and that analysis has just been flat out wrong, and it's why we have been on the right side of the resilient U.S. economy theme that we authored back in the summer of 2022. So just wrapping up with this final chart here, which is why are U.S. consumers resilient? We call this dynamic the West Village Montauk effect. Without getting into too much detail on why we call it the West Village Montauk effect, the key takeaway of the effect is that when you have a high stock of savings, you can have a negative savings rate. And because you can spend more of your disposable income into the economy because you no longer have to save because your stock of savings is quite high. And so how we get to that conclusion, there's multiple ways in which we get to that conclusion. However, we'll kind of unpack the ones on this chart specifically. So in terms of household assets, those are up 100. So in terms of, if you look at household assets from a cash perspective, checkable deposits plus money market fund exposure, that's up 135% since the end of 2019. If you look at household net worth, up 34% since the end of 2019. You look at nominal disposable personal income, that's up 27% since the end of 2019. And then you look at inflation, it's up only 21% since the end of 2019. So this is a business cycle whereby household cash, household net worth, and household nominal disposable personal income after taxes, are all outpacing the growth of inflation and have been since the start of the business cycle. And then secondarily, when you think about the amount of stimulus, pandemic-related stimulus that found its way onto the household balance sheet in 2020 and 2021, is via the form of real excess savings, actual excess savings, in our opinion, that those savings continue to be very much on household balance sheets. We're talking about $8.1 trillion of checkable deposits of currency plus money market fund exposure on the household balance sheet. That figure is up from $3.5 trillion at the end of 2019. So when the San Francisco Federal Reserve publishes misguided white papers about excess savings being depleted, in our opinion, we just think they're analyzing things wrong. And obviously, we can all, that's the nature of analysis in general. When you're talking about finance, we can all be looking at the same time series, but when you apply different statistical methods to the time series, you arrive at different conclusions, and we continue to arrive at a different conclusion relative to the view that excess savings are depleted. So we'll stop there. We'll turn it over to some questions before we wrap up here. It says, can you give a quick overview of what your macro course covers? Yeah, sure. So the macro course covers everything. It's very comprehensive. It's about 3 hours of us going through and with client questions along the way of all the various components of our process. So we unpack all of our quantitative risk management signals in great detail in that macro course. So just like we did with the global macro risk matrix, we have a series of quantitative risk management signals. Each of these models, so our Carding model, probable range model, our dispersion model, our positioning model, volatility adjusted momentum signal, our global macro risk matrix, and our macro weather model. We unpack each of those models in detail in our course, and then we talk about the frameworks and the methods that we use to analyze the economy and some of those key takeaways from the analysis of the economy in that macro course. So if you are an investor that wants to be a sophisticated investor but probably is not, the macro course is for you, because it'll teach you how to think about managing risk from the perspective of an institutional investor, someone who is being paid hundreds of thousands, if not millions of dollars annually to help their clients manage risk. So, I always say this, when you're doing anything, you should be emulating the best at that thing if you want to have good results. Don't go out there and emulate the people you see on Twitter, because the people you see on Twitter, by and large, are not great investors. The great investors are the people who you don't see on Twitter that we're meeting with on a daily basis, every afternoon in terms of our protocol clients across global Wall Street. So next question here. MXM says, when did you incorporate QRA supply into your process, and how has attention to it evolved on Wall Street institutions in your view? So I would say, we started focusing on the quarterly refunding announcement and the Treasury's impact on liquidity. I want to say a couple of years ago, probably late 2021 is when we really started to truly focus on that. In our opinion, it's become, one of those things that it become, from a narrative standpoint, it has the ability to really cause the market narrative to change. If you have a significant change in QRA, the balances and composition in terms of what the Treasury net financing policy should be. So like anything else, when I first started in this business, monitoring the Fed balance sheet wasn't a thing, but now we all have to care about the Fed's balance sheet. Monitoring forward guidance wasn't a thing. Now we have to all care about that. Monitoring the dot plot wasn't a thing, and now we all have to care about that. So over time, the things that the market cares about It's our job as investors to figure out what the market cares about and actually ultimately start to incorporate that into our process. And so, we do a great job of learning from our and other people's mistakes, and more importantly, learning what it is that markets are focused on vis-a-vis our quantitative risk management tools, so that we can incorporate those things and those learnings into our process in terms of being more observationally aware of changes in those signals. Again, we refresh all of these models daily, 6 times a week here at 42 Macro. So when something like liquidity goes from an uptrend to a downtrend, we're not, waiting for 2-3 weeks on Twitter for Michael Howe to tweet something about that. We are seeing and observing that in real time, and we're quite proud of our very robust observational process, because in my opinion, the difference between the average retail investor and the average institutional investor, which is obviously a much more sophisticated and much more successful investor, is institutional investors have really robust observational processes that tell them to change positioning when a signal changes. Retail investors build their entire portfolios based on their predictions of the future. And when something changes, they don't have a robust observational process to tell them to change their positioning fast enough so that they can actually do something about that in terms of maximizing upside capture in bull markets and minimizing downside capture in bear markets. So what we provide for our clients, both in terms of institutional clients, but also in terms of retail clients, is all the way up and down the institutional investor spectrum, is we provide those robust observational tools that provide clean, cogent signal that say, hey, something changed, do something different in your portfolio. Hey, something changed, do something different in your portfolio. A lot of times nothing changed. From mid-November to basically now, we haven't really had to do anything in terms of our process, because we remained in a risk-on market regime since then. We had Goldilocks the first kind of 4 months of the bull market, and then reflation for the last couple of months. And so in our opinion, if there's no change in signal, then we don't change our recommendations, our proper trade recommendations. We don't change our KISS portfolio construction process. We don't change anything. We only change when the signal changes. And that's, in our opinion, that's good risk management. The bad risk management is, well, I think this is going to happen in the future, therefore I'm going to put a bunch of positions on, and I will have no real way of determining whether or not this thing is going to actually make my positions go up in value. And so that I think, if you're investing like that still, I don't mean to be pejorative. I just want to remind you that that's not how institutional investors are doing it. And generally speaking, you should be trying to be like the best. When you pick up a basketball, nobody picks up a basketball, shoots a fadeaway jump shot and says, Darius Dale. They shoot it and say Kobe, or they shoot it and say Michael Jordan. And so Steph Curry, be like Steph Curry. Don't be like Darius Dale when it comes to playing basketball. I tell you right now. And so when you think about that same analogy for investing, and I hope this message is landing well amongst our audience and folks viewing this. Keep it moving here. How do you determine your conviction level for the macro weather model? There is no conviction level in the macro weather model. The macro weather model is a clean-cut quantitative system in terms of the macro weather model. The macro weather model is already giving you the conviction level of the 3-month forward outlook for each of those markets. So I don't really know where to how to answer that question, because that's not really a question that I've heard yet. There's no reason to get away from this conviction thing. Like, people want to hear conviction and conviction and conviction and conviction and conviction. What the hell does conviction is a gut feeling based on your emotions. If you're investing based on Darius Dale's gut feeling, i.e. subjective confidence, that's not a reasonable estimation that the thing is going to be accurate. It's all it's telling you is that this person has a clearly constructed narrative in their head. And we learned, I didn't invent that. The people who invented behavioral economics invented that. Again, I'll read this quote again. Subjective confidence in a judgment is not a reasoned evaluation of the probability that the judgment is correct. Confidence is a feeling which reflects the coherence of the information and cognitive ease of processing it. It is wise to take admissions of uncertainty seriously, but declarations of high confidence mainly tell you that an individual has constructed a coherent story in his mind, not necessarily that the story is true. If that might be the most important thing I can possibly communicate to investors globally. If I get hit by a bus tomorrow, I want that to be the number one thing you guys remember about Darius Dale, is that this thing about conviction and confidence and all this other stuff, that is a poor man's way of managing risk. The people who have boats and $1 million mega mansions in Miami and Palm Beach don't manage risk based on their conviction level or their subjective confidence. they have robust quantitative tools that are even better than ours that tell them that, hey, it's time to build a position in this, or it's time to take down your exposure to this. And that's what we're trying to do here at 42 Macro, is emulate the people that have the giant boats and the giant mansions, not the people who spend all day on Twitter, getting into beefs about, quarterly refunding announcements and things like that. That, in my opinion, is, you can, no, not again, that's for those people to do. What we're trying to do here is make and save money in asset markets, and we're doing that the best way we know how, based on my interactions with world-class investors for the past 15 years across global Wall Street. Next question here. It says, before KISS used to provide modal right left S&P targets, is price relevant to the new asset allocation system? Nope. Answer is that pretty easy. Or would it be just as long today at S&P 3000 versus 1000 as long as the reflation regime? So we've improved our process in terms of how we communicate that. Price level targets were just not a good way to communicate what we mean. And so we built our discretionary risk management overlay to create a little more clear guidance in terms of how discretionary investors should be interpreting 42 Macro research from the perspective of allocating assets. And again, this table we refresh on a daily basis. And in terms of how this table works, it's the combination. So it's the proper trade recommendations that you see here. For example, long max position in the S&P 500, whatever your max position is. We don't know what your max position is, but whatever your individual max exposure to a particular position is, it's telling you that you're getting the thumbs up from 42 Macro that you should be long a max position in the SPY. And need help in terms of determining which of these factors you should be long and short, then we again refer you to the key portfolio construction considerations here on this page, or the table back here on page 6. But in terms of getting back into our discretionary risk management overlay, so in terms of how it works, so the model will recommend a long max position in that particular asset if the asset is bullish from the perspective of volatility adjusted momentum signal, and it should be bullish in the current regime, and that condition is being met for the S&P 500. The model will recommend a long half position if the exposure is neutral from the perspective of its volatility adjusted momentum signal, but it should be bullish in the current regime. So Brazil currently satisfies that condition. The model will recommend a short half position if the exposure should be a short in the regime, but the exposure is currently neutral from the perspective of volatility adjusted momentum signal. And then lastly, the model will recommend a short max position in a particular exposure if the exposure is bearish from the perspective of volatility adjusted momentum signal, and it should be bearish in the regime. So this is a very important table in terms of keeping our clients on the right side of market risk from a factor dispersion perspective, because it not only combines the overall regime signaling process that we use from a market regime signaling standpoint, which is the dominant thing that we're trying to figure out and help you guys identify, but it's also incorporating the actual dynamic positioning sizing component based on the individual factors, current volatility adjusted momentum signal. So that, in our opinion, is a better mousetrap for helping investors identify the types of risk and the amount of bet and the sizes of bets that they should be making if they are discretionary investors. And if they're not discretionary investors, if you're a standard retail investor, someone who is not trying to basically pretend like they're a hedge fund manager and picking the factor dispersion, which I recommend you shouldn't, then we recommend you follow our KISS portfolio construction process. Our KISS portfolio construction process. This is the best mousetrap we have built that I have seen out there across Twitter, across everyone else's products. This is the best mousetrap, in my opinion, of helping retail investors stay on the right side of market risk. And so let's unpack in terms of how our KISS portfolio construction process works from a factor selection standpoint, risk management signaling standpoint, and a dynamic position sizing standpoint. So starting with the factor selection process, this is a 60-30-10 trend following strategy that is designed specifically to outperform the 60-40 portfolio over the long term. So the max allocations for each asset class is 60% in equities. The max allocation for the fixed income asset class is 30%. And then lastly, we incorporate Bitcoin as our alternative asset to manage. The max exposure to that is 10%. If we help if clients wanted to use different exposures, we default to SPY, AG, and FBTC. If clients wanted to use different ETFs or diversify into a basket of equity, fixed income, and alternative ETFs, then we refer them back to that discretionary risk management overlay, because we give them all in this table is all the data they need to implement the top-down and bottom-up risk management overlay. So let's talk about the top-down risk management overlay. We use this system to incorporate volatility targeting into each of the asset classes that can guide our overall target allocation to those asset classes to make sure that we are maximizing upside capture in bull markets and minimizing downside capture in bear markets. And then lastly, we use our volatility adjusted momentum signal to incorporate dynamic position sizing into our 60-30-10 trend following strategy. So, it's just a quick background on the back test here for KISS. So this is an out of sample back test that is actually more onerous than what the experience would be like if you're actually following KISS real time. And again, I use this process to manage 100% of my liquid net worth. And so, I can confirm that the back test confirms or is indicative of what you would experience as an investor. And so, in terms of how the KISS back test works, there's a few numbers that I would just draw your attention to on the page. So, in terms of the average annual return for following this 60-30-10 trend following strategy, using the global macro risk matrix macro market regime to incorporate the vol targeting, and using the volatility adjusted momentum signal to incorporate the dynamic position sizing at each of those ETFs. The average annual return for this out of sample back test starting in January 2018 is 13%. The average annual return for 60-40 throughout that time period is only 7%. So obviously trouncing 60-40. And then if you wanted to run KISS without the top-down risk management overlay and without the bottom-up risk management overlay, i.e. you're just always long 60% stocks, 30% fixed income vis-a-vis ag, and then 10% Bitcoin, then your average annual return will be slightly better, but your max drawdown would be significantly worse. And so the max drawdown for KISS with those top-down and bottom-up risk management overlays is minus 12%. It's the only double-digit drawdown throughout the entirety of this out-of-sample backtest. If you look at the 60-40 portfolio, the max drawdown is essentially double that at minus 22%. And oh, by the way, there are two crashes of minus 22% in the 60-40 portfolio, whereby there's only one double-digit decline in the KISS portfolio throughout this throughout the duration of this out-of-sample backtest. And then lastly, from a max drawdown perspective, the max drawdown of the running KISS raw without those top-down and bottom-up risk management overlays is minus 26%. And oh, by the way, you crashed 3 times. So what that tells you is that the value of our KISS portfolio construction process is not only in identifying the need for incorporating alternative assets into your portfolio to get yourself out of being overly indexed to what I think is a structural bear market in the fixed income space, but also in executing the top-down and bottom-up risk management overlays from an vol targeting, dynamic position sizing perspective, really do eliminate a significant amount of volatility from your portfolio, i.e. you haven't crashed in KISS, but you would have crashed 3 times in your overall portfolio if you were trying to follow 60-30-10 without our top-down and bottom-up risk management overlays. And so just wrapping up here real quick, where we are currently in terms of KISS. Obviously, we update this. Our clients we maintain our KISS portfolio construction process in our around the horn for our clients. So we're currently at 35% cash. That's we're at 100% of our max exposure of 60% in the equity market vis-a-vis the SPY ETF. We're at 0% of our max exposure of 30% in the fixed income market vis-a-vis the ag ETF. We're at 50% of our max exposure of 10% in Bitcoin vis-a-vis the FBTCF. How do we get to those exposures? So the target allocation for the stock market is 60% because we are in a risk-on market regime. The actual exposure for the stock market for the SPY equals 100% of that because of because the VAMP signal for the SPY ETF is bullish. In terms of the fixed income, the target exposure or target allocation for the ag ETF is only 15% because we're in an inflationary market regime, and the actual exposure equals 0% of that because we are the ag ETF is bearish from the perspective of our volatility adjusted momentum signal. And then lastly, with respect to Bitcoin, the target allocation equals 10% because we remain in a risk on market regime, and the actual exposure to that is only 50% of that 10% because Bitcoin is neutral from the perspective of our volatility adjusted momentum signal. If it was bullish, then it'd be 100%, i.e. equals 10%, versus 50% of that equals 5%. And so this is a dynamic process. There's about 3 trades in this KISS portfolio construction process per month. At least that's the history of that in terms of the out of sample back test there. And so again, as I mentioned, it's been doing a great job of keeping our clients on the right side of market risk. For those who may not want to, for retail investors that just want to retire on time and comfortable and don't need to pretend like they're hedge fund managers, kind of whipping around factors, going along this factor, short this factor, and having all these different themes in the portfolio. If you want to keep it simple, but actually make money while keeping it simple, then our KISS portfolio construction process is for you. And if it's good enough for me, and I'm a sophisticated institutional investor, I highly recommend that you check it out and stop trying to make investing harder than it needs to be. Because again, nobody's telling you to put on factor long short bets. Only your desire to put on factor long short bets is the reason you may be potentially struggling with those. So let's get back to the queue here before we wrap it up. Would appreciate your perspective on the complementary role that quant and technical analysis research may provide in portfolio risk management? I observe that changes observed using your framework may coincide with immediate time for, I don't know if I can understand that question. If Alonzo, just pop that question in the maybe revise it a little bit and pop it into our community chat feature so I can address that, because I don't really understand it. But I appreciate you for tuning in. And then lastly, last question here says, if you can share what questions, topics do Protopro members ask you that you think retail investors should think more about? I don't know that they ask different questions. By and large, they ask better questions. Obviously, they're professional investors, and don't be offended when I say that. These are really smart institutional people who are getting paid lots of money with fancy degrees to do fancy things in financial markets. They ask a lot of the same types of questions, like, oh, okay, what the hell happened with the QRA? What's going to happen with liquidity because of this? Dot, 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 dot. What they care about most when they ask those questions is, how will it impact the factor long short bets that they are currently making, and the duration and sustainability and conviction level in those factor long short bets that they are currently making. What institutional investors live in fear of is having a significant drawdown, a significant enough drawdown that causes them to lose their seat, i.e., get fired from their seat. And so, so the institutional investors live in, if you, let's just say you had the entire reflation playbook on your long risk assets, your short defensive assets, your long high beta, your short low beta, your long cyclical, short defensive, across your equity and or credit portfolio, or you're doing you're putting on the reflation playbook and the fixed income space as well, your long spread products, your short treasuries, your short mortgage-backed securities, and you had that kind of playbook on as well. What they live in perpetual fear of is, okay, what's going to cause those long short bets to unwind? Because when you the reason they live in perpetual fear of that is because there's not a lot of market liquidity when factor leadership changes. When factor leadership changes, all the risk management systems of, I'm not even going to name names because, some of them are clients, but the major multi-manager platform, hedge funds that we all are very aware of, the people with the big boats and the big mansions, those risk management systems all change a lot of times very similarly. And you start to see a lack of liquidity in terms of helping you get out of unwinding those factor long short bets. So we talk extensively about connecting the dots from a growth, inflation, and policy standpoint on what could cause, risk assets to stop outperforming defensive assets, or what could cause spread products to stop outperforming treasuries. Should you be starting to high grade your credit portfolio from high yield to investment grade, or vice versa? Should you be hiding out if you're taking more risk in things like triple C's or private credit? Those are the kinds of discussions that we have with institutional investors that are much more specific to their investment strategy, their investment duration, their time horizon, the bets that they place, and more importantly, the kinds of things that are going to be more impactful for the assets that they trade. So it's not that they ask different questions. They just ask questions in a more thoughtful, no offense, generally more thoughtful manner. And then more importantly, it's a lot more endemic to what it is that they're doing for their clients on the institutional management side. So we'll wrap it up there. This has been a nice deep dive into some various elements, what I thought are, four of the more important elements of our process in terms of our global macro risk matrix, which again helps us identify the market regime in terms of our macro weather model, which helps us identify whether or not the market regime is likely to change and what it's likely to change into, and then our qualitative research process from a growth, inflation, and policy, piece in the puzzle together standpoint to help investors identify, okay, if the market regime is going to change, what is it going to change into? And I'll leave you guys with this: challenge yourself as an investor to start thinking about investing. If you've had average to below average results as an investor, don't do the same things over. If you, and again, it's not investing. It's very similar to pretty much any discipline you have. It's one that requires you to overcome a lot of emotion. But I liken it to being a parent, or being anything in life that requires you to actively work at to get better at. It's something that you need to put a lot of time and resources in, or pay people like us, 42 Macro, to put in those time and resources to develop these tools and give you access to these tools so that you can have a more robust observational process, as opposed to constantly relying on predicting. People suck at predictions. The most stuff that happens in the economy and asset markets, people do not predict. The vast majority of outcomes from a growth standpoint, from an inflation standpoint, from a policy standpoint, people do not predict. So if you're basing all of your positions in your portfolio based on prediction, you, in our humble opinion, you're probably going to struggle. You might hit it out the park for a year or two, but over a long period of time, if you're relying on your ability to predict the future, which nobody does well over long periods of time, then your portfolio is probably going to reflect that, i.e., continue to have average to below average results. So it's our job as investors to help educate investors who may be overly reliant on prediction that, hey, the best investors in the world are not overly reliant on prediction. They're overly reliant on observation and observing, more importantly, when signals change so that they can do something different in their portfolio. Because again, investing is not about forcing the market to go in the direction of your positions. It's about letting the market do whatever the hell the market wants to do and taking advantage of whatever the hell the market wants to do because you have a robust enough observational process to get into the right position. So we'll wrap it up there. Darius Dale, I know it's a weird weird episode without a guest this week, but hopefully everyone got some out of that in terms of this extensive Q&A. We'll catch you back here next month. So everyone, thanks again. Cheers.